This is not a metaphor, this is math. A person who can afford a $50 pair of boots wears them for 10 years. A person who can only afford $10 boots buys 4 pairs in the same decade. Same feet, same decade, different price tag. The poor person paid less per purchase and more overall. That gap is not an accident. It is a system, and it does not stop at boots. Every layer of the financial system, banking, credit, housing, transportation, even groceries, is priced to charge less to people who already have money and more to people who don't. The system is not random. There is a concept in economics sometimes called the boots theory. The idea is simple. When you cannot afford quality, you pay for quantity, not by choice, by constraint. A $10 pair of boots lasts 6 months. A $50 pair lasts 5 years. Over 5 years, the $10 buyer spends $100. The $50 buyer spends $50. The person with less money pays double. This is not limited to boots. It is the foundational mechanism of the poverty premium, the hidden surcharge that runs through every transaction a low-income household makes. The pattern is always the same. Upfront cost determines long-term cost, and upfront cost is exactly what low-income households cannot afford to optimize. That loop is not a character flaw, it is a structural trap, and it gets worse at every layer. Over 18% of American households do not fully participate in the banking system. They are unbanked or underbanked, meaning no checking account or an account they cannot afford to keep open. Here is why. A traditional bank account typically requires a minimum deposit of $25 to $100 to open. Many charge monthly maintenance fees of $5 to $35 if the balance falls below a threshold, often $500 or $1,500. If you are living paycheck to paycheck, that threshold is a landmine. One bad week drops you below the line. The bank charges you $15 for not having enough money. The fee pushes you further below the threshold. The next month, another fee. You are paying the bank for being poor. So millions of Americans opt out. They use check cashing services instead. The average check cashing fee is 2 to 3% of the check amount. For someone earning $2,000 a month, that is $40 to $60 gone every month just to access their own money. Over a year, that is $480 to $720. Over a working lifetime, the cost of being unbanked can exceed $40,000. That is $40,000 paid not for goods, not for services, not for anything, for the privilege of not having a bank account. Now look at what happens to the people who do have accounts. The average overdraft fee in 2025 was approximately $27 per transaction. Americans paid over $12 billion in overdraft and NSF fees in 2025. And here is the structural kicker. Roughly 9% of bank accounts generate 79% of all overdraft fee revenue. The system is not charging everyone equally. It is targeting a narrow population, overwhelmingly low income, and extracting from them repeatedly. A $4 coffee becomes a $31 coffee because the account was $1.50 short. The bank does not decline the transaction. It approves it, then charges a fee nearly 7 times the purchase amount. Declining would cost the bank nothing. Approving earns them $27. The choice is not yours. It is the bank's, and they choose the fee. If you have excellent credit, the financial world is on sale. Prime borrowers receive interest rates of 15 to 18% on credit cards, access to 0% introductory offers, and sign-up bonuses worth hundreds of dollars. If you have poor credit, the same system charges you 25 to 30% APR or more. The average APR for credit card accounts assessed interest was over 21% as of early 2026. For subprime borrowers, it climbs well above that. The people most likely to carry a balance, low-income households, pay the highest rates. The people least likely to carry a balance, high-income households, pay the lowest. Then come the late fees. In 2024, Americans paid approximately $17 billion in credit card late fees. Federal Reserve survey data shows that low-income households pay late fees at roughly 3.5 times the rate of high earners, 14% versus 4%. The Consumer Financial Protection Bureau attempted to cap late fees at $8 in 2024. Congress repealed the rule. The cap is gone. The fee remains, typically $25 to $35 per occurrence. So the same missed payment that costs a high-income household nothing because they have savings, auto-pay, and a buffer, costs a low-income household $35 plus a penalty APR increase that can push their interest rate above 30%. The penalty for being late is higher interest. The cause of being late is not having enough money. The system charges you more for the exact condition that made you late in the first place. When the banking system and the credit card system both push you out, the payday lending system pulls you in. The average payday loan is approximately $161. The typical structure is simple: $15 to $30 per $100 borrowed, due in 2 weeks. That works out to an annual percentage rate of 391%. That is not a typo. 391%. The business model depends on repeat borrowing. The vast majority of payday loans are not one-time emergencies. They are the second, third, or fourth loan in a chain. The borrower takes a new loan to pay off the old one. The fee stacks. A $300 loan can cost $450 in fees over 6 months, and the borrower still owes the original $300. Payday lenders cluster in low-income neighborhoods. The industry generated over $11 billion in revenue in 2024. That revenue is extracted almost entirely from households that cannot afford a $400 emergency, which is exactly why they walked in. The system does not offer a ladder. It offers a treadmill. If you cannot afford a $400 television, a rent-to-own store will let you take it home for $20 a week. No credit check, no upfront cost, just sign. The contract runs 78 weeks. Total payments, $1,560. The same television costs $400 at retail. The Federal Trade Commission has documented that rent-to-own prices typically run 2 to 3 times retail, sometimes more. The industry generated approximately $11.5 billion in revenue in 2024, operating out of nearly 5,800 locations across the country. The customer is not ignorant. The customer is constrained. They need a refrigerator. They need a bed. They do not have $400. They have $20 a week. The store knows this. The pricing is not designed to be competitive. It is designed to extract the maximum from the minimum cash flow. This is the Boots theory applied to appliances. The person who can afford the $400 fridge pays $400. The person who cannot afford it pays $1,560. Every mechanism in the system feeds the same loop. Low income restricts upfront capital. Restricted capital forces short-term, high-cost decisions. Those decisions extract wealth. The extraction keeps income low. You will not dismantle the system alone, but you can see it, and seeing it changes the math. If you are unbanked, credit unions offer accounts with no minimum balance and no monthly fees. They are not charities. They are structured differently. Member-owned, not profit maximized. Find one. If you are carrying a credit card balance, the interest rate is the emergency, not the balance. A balance transfer to a lower rate card or a call to your current issuer requesting a rate reduction works more often than people think. The bank would rather lower your rate than lose you. If you are considering a payday loan, the $15 fee per $100 is a 391% APR. Ask yourself what happens in 2 weeks. The answer is this: the same problem plus $45. If you are looking at a rent-to-own contract, multiply the weekly payment by the number of weeks. Write that number down. Compare it to the retail price. The number will be 2 to 3 times higher. That gap is the poverty tax. Walk away. The system charges less to people who have more and more to people who have less. That is not a glitch. That is the design. The system is not random. This is behind the spends. Decoding the systems behind spending.